Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, Dan Rohinton, portfolio manager at IA Global Asset Management, is our guest co-host. He is helping us look back at 2025 and into 2026 with companies on the rise. And then we are talking to the CEO of Geotab, Neil Cause, about the vehicle tracking technology company's next big move. And of course, we want to hear from you this morning on First Call. Call us with your questions, and we'll have Dan answer as many of them as he can. The number to call, 1-855-326-6266. We will open the phone lines in about 30 minutes, and our email address is firstcall@bellmedia.ca. Now, some of the stories we're tracking for you here in the BNN Bloomberg newsroom. The Bank of Nova Scotia is planning to revive the metals trading desk it dismantled at the peak of the pandemic. The new desk will trade, lend, and hedge raw materials, including precious and base metals. The bank has hired recruiters to reach out to commodities traders, sales specialists, and strategists to staff the unit. The move follows record-breaking rallies in gold, copper, and silver that have renewed interest in metals trade. U.S. President Trump has ordered a blockade of sanctioned oil tankers going into and leaving Venezuela. The move severely targets the country's economy, but will have a less profound impact on global markets due to the diminished status of its oil industry in Venezuela. The OPEC members' crude output could potentially rebound if the governing regime were to change. The Maduro government has characterized the U.S. actions as a grab for Venezuela's oil reserves, the biggest in the world. Warner Brothers is advising its shareholders to reject a hostile takeover bid by Paramount in favor of its original agreement with streaming giant Netflix, deeming the Paramount offer inferior and inadequate. Executives from both Paramount and Netflix have argued that they would be the best owners and utilize the Warner Brothers library to boost streaming operations. And now our top line story. U.S. President Donald Trump says he was ordering a blockade of sanctioned oil tankers going into and leaving Venezuela, ratcheting up pressure on Caracas amid a U.S. military buildup in the region and the threat of land strikes. Bloomberg's Stephen Stapczynski reports.
He's been putting pressure on this regime, and one way to tighten that pressure even more would obviously be taking one of their biggest revenue areas, and that's oil. Putting curbs on their oil exports. Already, he's been tightening that through the seizure of a ship earlier this month, as well as just restrictions in general, have helped to curb the amount of money flowing into Venezuela and in particular U.S. dollars. But by doing this, you're really siphoning off a very large portion of the revenues from that the regime can get. Now, there are a few reasons for this. One, Trump has for a long time blamed Venezuela for a flood of drugs coming to the country. You've seen the U.S. administration hit several, over a dozen ships that were suspected of carrying drugs and being involved with the cartels. He's also blamed Venezuela for a surge in illegal immigrants coming into the country, which is something that he struck quite hard during the campaign trail. So, of course, this is sort of a ratcheting up of this pressure, and it's in the onset that we're in a bit of a market glut. The U.S. is producing a lot of oil. Prices are pretty weak. So with all that together, Trump and the administration thought that this was their time to strike.
Yeah, and we can see that, can't we, when we check the oil market. So, yes, we're seeing a move of almost 1.5% up on oil prices, but Brent is still below $60 a barrel. So, Stephen, what does it mean? How central does Venezuela play? What kind of the centrality of that nation in terms of its oil exports onto the market and how this could affect pricing going forward?
I think this is more sentiment-driven, any increase that we see today, than really actual changes in the fundamentals for the oil market. Because, listen, Venezuela last month was producing or exporting roughly 500 to 600,000 barrels a day. Now, to put that into perspective, the global oil market consumes about 100 million barrels a day, so that's less than 1%. So if you remove even all of that, and that's not what Trump is suggesting. He's suggesting just the shadow fleet ships, these dark sanctioned ships, which make up a portion, but not all, of the export from Venezuela, you're not going to be really changing the fundamentals very much. But it does show some sort of discombobulation in the market. There is obviously there's going to be some degree of scramble. A lot of that oil was going to China. Where do they find the replacements? Are there the grades that they can find elsewhere to feed their industries? That's going to be something in focus. But when you do zoom out, a 1% gain is nothing compared to where we're sitting in the oil market. We had prices fall just recently this week to the lowest level since 2021. Oil prices are weak. There is a glut that is expected to get worse in 2026. So even if you were removing these Venezuelan barrels from the market for a prolonged period of time, you're not going to be seeing a sustained increase. In fact, there's probably more downside for the oil market.
Okay, let's bring in our guest co-host, Dan Rohinton, portfolio manager at IA Global Asset Management, to get his thoughts on that. Dan, what do you think of this? Is this a one-off, or is there more to come?
Yeah, I think let's take a step back and just explain the Venezuela situation, if you will. So the military buildup plus basically blockading the shadow fleet, which is very common. So it's if you want to understand why oil prices are down, but Russia, which has 12 million barrels a day that they export, how does it still make its way into the world's oceans? It's because of the shadow
fleets, right?
Venezuela does the same. They've been basically selling off some of their gold initially. So Maduro's been using other mechanisms, but oil is what keeps call it the militias paid in Caracas. So cutting that off is basically a pressure campaign to create regime change. I think there's no doubt about that. So you don't need to send in troops. You just basically siphon off the money, and then let it take care of itself. The downstream consequences of that for the global markets, for oil, I fully agree with Steve there. It's really negligible. I think there's a bigger story.
For now, though.
I would say let's take a big step back about the oil market. So if you had said there's wars that have gone on, hot wars in the Middle East from time to time in the last few years, there's a huge one of the largest producers in Europe, which is Russia, is in a full-blown conflict. And then there's Venezuela, which has seen its oil production. It's only 500,000 today. But if memory serves, it was at least 1.5 not that long ago. So if you see that type of supply disruption, and you told me oil was $56 a barrel, that tells you something. So I think the real story about all of what we are seeing isn't that the U.S. is going to make an example out of Venezuela to show what belligerence against U.S. grand strategy does, which I think is the story here underlying the military buildup. The second real story is, despite all of this, oil is barely going up. This is a whisper of a move for this type of action.
But it has one of the largest proven reserves in the world, does it not? And if there is some kind of a change, could they not?
Yeah.
But they're involved there with OPEC, though, aren't they? With OPEC Plus.
Yeah, but they all cheat. It's a complicated story, actually. So when you think about when everyone's got a lot of reserves in the ground, what they don't tell you is, well, what's the cost to get it out?
To get it out, yeah.
Venezuela has a lot of the Canadian attributes, which is very heavy oil. And the only reason that the U.S. allowed Venezuelan oil to come into the U.S. was they need to blend Canadian heavy or replace Canadian heavy with it, and vice versa. So it's heavy, expensive oil that takes a lot of engineering to get out of the ground. So you could say you have the largest reserves in the world, but if it costs $60 a barrel, and oil is 56.
Math isn't hard.
But I think the real point here is when you think about oil prices and where the direction of travel is going, we are moving into a post-oil scarcity world in the next 10 years. And I don't think I would have said that many years ago. And the reason for that is the amount of solar that's being put into the ground, all the other natural gas peakers and baseload that's being spun up, on top of the fact that nuclear is having its moment in the sun once again. All of these things is abstracting away the energy use case. So 100 million barrels of oil a day, will it be more 10 years in the future? Of course it will. But it will not be the primary bottleneck energy source in the way that it's been historically, and that's generally bad for prices. And then the whole question is, we talked a lot about Venezuela, we talked a lot about Russia. What does it mean for Canada? Canada's wealth and prosperity is anchored to the energy markets. And the pipelines aren't full on the way out of Alberta right now. That is an interesting thing to monitor, and we're probably going to have to find other sources of competitiveness in our national economy, because the same reason that Gulf states have moved on, we've been slow to extract it, And I think that moment in the sun for oil has passed.
And so Canada, you just put a big question mark for Canada. That's a big challenge then, if we have to move away from that dependency on income from oil.
It just won't be as profitable.
Yeah.
Right? So if you could, back in the day, you could only fill up your car with gasoline or diesel. It's dinosaur juice one way or another.
Yeah.
But if you have EVs, you have a different charging system. You could use the fusion that comes from the sun, things like that. So alternative sources of energy avoids what's known as the spark spreads or the peaking prices that do happen where you earn outsized returns. So this is the broader dynamic in the Canadian energy patches. We have very strong, stable supply, but the demand picture around the world is shifting from an oil hydrocarbon centric world to something else, and that something else is bad for the Canadian wealth accumulation.
Okay, we'll have to leave it there, but we'll talk more coming up. After, we'll take a look at the markets, though, before the bell. Let's see how things are shaping up on the markets now, and we will start with the U.S. futures. They're up slightly on softer than expected job data, likely meaning more possible Fed rate cuts. And of course, the U.S. blockade on Venezuela is shaping some sentiment there. You can see the Dow up by a quarter, NASDAQ by 0.42, and the S&P 500 up by 0.33%. And looking at the major Asian markets, a tech rebound and optimism over regional export demand fueling an upswing across the board there. The Nikkei up by a quarter, Hang Seng up by 0.92, and the CSI 300 up by 1.8%. In Europe, resource-linked shares and financial fueling helped. Financials helped fuel a bit of an uptick, but you can see it kind of has been a change now. Looking across the board, the FTSE is up 1.5, as we expect we saw the slower UK inflation number increasing the odds of a rate cut there. CAC 40 down by a quarter, and it's a wash in Germany. And looking at the TSX from yesterday, another down day. It was dragged down by major oil and gas producers as oil hit that 5-year low. Maybe a bit of a different story today with that U.S. embargo on Venezuela. We'll see what oil's doing in just a minute. But first, though, let's see who some of the movers were yesterday in the TSX. Curaleaf, wow, up 23%, more than 23%. It has been a roller coaster for it. It shows up either as one of the biggest movers or one of the biggest losers. NFI up by 12.2%, and Imperial Oil leading the way down 5.25%. It was off by, and International Petroleum as well, off by 5.3%. Looking at the metals, you can see all of them pretty much in or near record territory as demand for safe havens increases. Gold is up at $43.56. Silver, record territory at $66.10. And copper's up, and it's at $5.43. Okay, taking a look at oil, you can see that downward drop yesterday for WCS. I think 4.5% it was off by down to $41.90. Now that the blockade we're looking at for today may have an impact on oil today, and let's see what it's doing with WTI right now. Where is it trading at? Yeah, there's a bit of a jump. It was at a 5-year low. It's up 1.8% right now. Well, Warner Brothers Discovery is advising its shareholders to reject a hostile takeover bid by Paramount Skydance in favor of its original agreement with Netflix, deeming the Paramount offer inferior and inadequate. For a closer look, let's bring in Dan Rohinton, Portfolio Manager at IA Global Asset Management. Dan, really surprised? Is it any surprise really that we're seeing this, that they're saying no to it?
Yeah, I mean, it's one of those things, right? If you push comes to shove, do you want to be acquired by Netflix, which is a several $100 billion market cap, versus Paramount Skydance, which is significantly smaller, say 30, 40, if memory serves. Mm-hmm. So there's the classic case of the bid for Paramount is higher than what Netflix is, but the deal certainty is lower. That being said, it's important to say Paramount Skydance is basically backstopped by Larry Ellison and his son, when Larry's one of the richest people in the world. So could he pledge a few Oracle shares and get it done? Of course he can. So I think maybe the deal quality is, sure, there's something to be said there. There's also important to understand in media, politics and personalities play a huge role. So if you're the CEO of Warner Brothers Discovery, and you've been making a pretty penny in your day, suddenly being subservient to Larry's son
isn't
exactly going to sit well.
Yeah.
So you're going to make a tempest out of a teacup, a tempest in a teacup with the deal quality, when really you just don't want to be subservient to David Ellison. You know what I mean?
I mean, like one of the quotes is they say the Ellisons misled shareholders in the takeout. So it sounds like it's getting a bit ugly. Is it in the end? Is it really just like it's all politics or local? All business deals are one-on-one essentially.
I think there's a lot to say from the business case of, well, can you bring in and be a credible, call it number 2/3.
Yeah.
So Netflix being the number 1 in streaming video on demand, Disney Plus being really number 2. Could Paramount Skydance scoop up the rest as Warner Brothers was, remember, not just the old Warner Brothers Looney Tunes as memory might serve, but it's actually Discovery, which was some of the residual assets as well. So this is the last amalgamation of all this iconic content and the library that's available. And the CEO, if he makes somewhere between $25 million to $50 million bucks a year.
Wow. So
for seeing your revenues go down and being a 10% free cash yield, that's an exceptionally high compensation number. So I think that's where the dollars about David himself and the personalities really come into play. But the case to bring these two together and drive content is true for Paramount, and it's also true for Netflix. Can Netflix distribute it better? Yes, but you also run into antitrust. So I think push comes to shove. I think this is all politics are local, and all business deals are personality based. And I think this is a case of that.
Is this a better push, though, should they go for Warner? Should they go for Netflix? Is that the better deal, even though it's not as much money?
If you're a shareholder, you probably want it to go towards Netflix, but you also have to recognize that getting it through the line for Netflix is going to be significantly
a lot harder, right?
Because then it goes into the classic antitrust case of, let's use Google as an example. Is it a search engine, or is it something that's in the broader advertising market? So your market share is very contingent on how you define your market to be.
Yeah.
And I think Netflix is going to have a far harder time and a far more arduous process. And in the case of a Warner Brothers Discovery, you have to understand that the value of these assets is falling every single day. So you probably, deal close certainty is just as important as the balance sheet of the company that's buying you. So I think Netflix is probably better, but it comes with the downside of it might take an extra year or two. So it's a 50-50 shot. I'm really not sure.
Okay, we're going to have to leave it there, but we've got more coming up. Up next, we'll be back with Dan for a special year-end wrap of On the Radar. All right, time for On the Radar, and we're going to kind of take a look at some of the best performing stocks that, Dan, you like this year. And Dan Hinton, of course, portfolio manager at IA Global Asset Management. And we're going to take a look at the stocks that were on everyone's radar. And first up for you is Western Digital.
Yeah, and I think we can loop in the rest of the memory space as a whole. There's all kinds of different memory. But when you think about what's been going on, is there's a memory squeeze that's happened, and it's being priced into these equities. So if you look at a SanDisk, it's up almost 500% on the year. Western Digital, over 200%, I believe. Micron, and then you can go to the other side of the pond, the Pacific, and see that SK Hynix and Samsung, which are some of the big memory players in Korea, all of them have had a tremendous run. And I think the reason for that is there's a belief that memory is in significant undersupply. And these stocks have historically been cheap and deeply cyclical, and they've priced in a big recovery cycle that's been going on. So the real test will be next year is, are we going to see more supply come on, and will it truly be scarce or not? But I think all roads lead to a pretty significant memory cycle, and this is where these companies have been pricing in.
And even though it's been priced in, you still see room for it to grow?
I'm not too sure. It was more just to appreciate what the biggest movers of the year are and what it looks like going into next year. I think it's a bit of a toss-up. Memory at this scale to bring on is hard, but over time, these deficits do turn into gluts as time goes on, as with any capital cycle. But I think it might be too soon to call it the end of the memory cycle early next year. Yeah. But maybe mid next year to late next year might be a different story.
And Seagate is one of those similar as well?
Yep.
All the same situation for it, eh?
Different types of memory, different types of end uses, but the underlying driver is all the same.
I just saw a new word, DRAM.
DRAM,
Or is it DRAM?
It's DRAM.
I like DRAM.
Markets will move at their pace, and regulators are going to catch up probably too late. And I think this is going to be the dynamic here as well. So Robinhood is one of those players. Interactive Brokers is one of those players. Kalshi and Polymarket. All of these companies have, in different capacities, large platforms behind them. So you can bet your dollar that it's going to come through in a big way on these platforms, and we're going to see call it a golden age of gambling pick up.
Okay, let's get one more in. We're almost out of time. Palantir.
Yeah, I think this is a classic case of one of the most purest expressions of AI native companies, and they call what their go-to-market is what's known as forward deployed engineers, which was call it a spin on what they used to do with the U.S. military, where they would have engineers sitting in Afghanistan and things like that, helping to solve the military's problems. They're taking that go-to-market approach for the enterprises, where if you're a business, a Palantir engineer will come in and help solve your AI problems. So it's a phenomenal model. It's actually a very profitable company in its own right. The CEO is a bit eccentric and what have you, but it's a retail darling. So is it worth 50 times sales? I wouldn't be so sure about that, versus when ServiceNow is worth 15. But it's one of those things you got to respect good execution where execution has happened, and Palantir is absolutely one of those companies. Okay, we're going to leave it there. And coming up, Geotab. You may not have heard of it, but it just secured a few new big contracts, and its current revenue is more than $1 billion. We're talking to the vehicle tracking technology company's next big move with CEO Neil Cause. That's right after the break. And of course, our phone lines will be open for first call. Canadian press is reporting Ottawa and Ontario are set to sign a deal Thursday to reduce the regulatory burden on large projects, including the road to the Ring of Fire. Provincial and federal sources telling the publication Ottawa has agreed to eliminate any duplicate work on its impact assessments on large projects. A source in Premier Doug Ford's office also told Canadian press that the changes will dramatically speed up big projects across Ontario. The federal government has signed an MOU with Canadian artificial intelligence platform Coveo to boost innovation and integrate Canadian-built AI into core government operations. Ottawa will work with it to adopt technologies that will help create cost-effective services for Canadians while building and ensuring Canadian digital sovereignty. U.S. President Donald Trump has ordered a blockade of sanctioned oil tankers going into and leaving Venezuela. The move severely targets the country's economy, but will have a less profound impact on global markets due to the diminished status of its oil industry. The OPEC members' crude output could potentially rebound if the governing regime were to change. The Maduro government has characterized the U.S. actions as a grab for Venezuela's oil reserves, the biggest in the world. And taking a look at the markets right now, there is a rebound today. And looking down south, in the U.S. futures, the Dow up by a quarter percent, 122 points right now. The NASDAQ 100, it is also all pretty much in the same range right now, up by 0.27. And the S&P 500 futures up by about 0.23% or 15 points right now. Geotab can count a few big names as its clients, including the U.S. government, PepsiCo, and New York City. It recently broadened a contract with Sourcewell and Canoe. With more than $1 billion in revenue, this Oakville, Ontario company is one to watch. Here to talk about the vehicle tracking technology company is its CEO, Neil Cause. Neil, thank you very much for joining us.
Thanks for having me.
It's a $1 billion company that not a lot of people know about. You've kind of flown under the radar and you've stayed private that entire time. Let's talk a little bit about that. 25 years now, and you stayed private. Why have you done it that way?
You know what, it was always one of these things to start a small little family business, keep it to 5 people, a little private company. And now we're 3,700 people. So, you can't, once the reins are out, you got to let them go. So, yeah, it wasn't intended that way, but very happy it worked out this way.
And you've been approached and people have asked you to get involved with it and you keep saying no.
No, I mean, it was, I did make a little bit of money in South Africa selling a software business. So I funded $500,000 was the peak that we put into Geotab. And it was kind of exciting to see kind of Geotab grow. But we never needed more than that. So fully bootstrapped and never had outside investors. I kind of wonder, it's an A-B path, right? Maybe investors would allow Geotab to be much bigger than it was today. We'll never really know. Just happy with how it kind of turned out.
When you think about the footprint of telematics and having that back history, do you see value in what that brings to the autonomous vehicle conversation? Because a lot of the data that Tesla and Waymo have generated is very recent, but you have a backlog that I think is about as scarce as it comes. So I'd be curious, what's your perspective on just what you can bring to the conversation there?
Yeah. Look, I mean, I think telematics does many, many things. Obviously, in the world of no driver, what is the role of telematics for evaluating the driver and making sure that the driver is driving safe? Although we work with a lot of the autonomy companies today to do things like accident reconstruction and have an independent source of data. So obviously these vehicles need maintenance as well. So being able to manage and do predictive maintenance on these vehicles is still a key thing. But you're absolutely right. Our knowledge and understanding, our data is our most prized assets. And being able to understand origin and destination and flow of goods, being able to understand what are the most dangerous intersections across the world, understanding the behaviors that lead to accidents, understanding all of the maintenance and data, the impact of, for example, snow and rain on and speeds of driving, how that impacts the accident rate. So yeah, data is everything really in this new world, powered by AI especially.
And how do you bring the AI, call it, or maybe AI is a bit more of a grandiose term, large language models, and call it next token prediction. How do you bring that into the business that you have today? Because you have the most critical asset that LLMs need. So how do you work through that?
You know what? Interesting. I mean, look, we're a private company, so we don't need to throw AI around to do anything with our valuations. But at the end of the day, we've been using AI for more than 10 years. And where AI comes in is, AI means different things. But for us, it's like the predictive models. So for example, looking at your battery voltage, is this battery going to fail? Looking at driving styles to see who's likely to have an accident. So that's one kind of level of AI. And obviously with the advent of LLMs, where you can now, you can converse with your data, it really changes the game from our point of view. I always thought that Geotab was a company that was about producing insights for anybody who runs fleets, right? And fleets, let's just be honest, run the world. That's just what it is. And I've changed my mind. I actually think the AI is going to have the ball on that. It's going to be able to pull all of the data from all of the areas of your organization and do a better job than we could ever do by just having your telematics, logistics data. So I think our role has to transition to being one of collecting data. If data is fuel for AI, the amount of data and the quality of the data is really the most important thing. So that's what we're going to be focusing on.
And R&D is everything to you. Is that where that focus is right now? You spend 150 million US a year on it.
Correct.
Is it all leaning towards AI right now?
It is, and I'm going through the hardest time of my career, if I'm honest. This transition to AI is one of the hardest things that I've had to do, and I realize, as an organization on the forefront of tech, if we don't embrace AI and weave AI and turn ourselves into an AI-first company quickly, we're just going to be disintermediated. I mean, we're on a treadmill and we have to move fast. So it's the hardest thing to reshape an organization to be AI first. And we're seeing the engineers' times, the ability to produce output double. And of course, it's with people. It's not AI on its own. It needs to be steered and managed. So I'm excited about the future, but it is a big, hard transition right now.
And how are you doing that with your people? How are you getting them to buy into that?
It is a constant task of communication. It is goal setting. It is actually setting up, squads that actually go in and take areas of the business and redo them in an AI-centric way. But it's really, really hard because, if I have to be brutally honest, I think that, I'm going to try my best to make sure we don't lose any people. But I can't put my hand on my heart anymore and say, I don't think that we're going to be able to maintain all of the jobs and all of the roles. I think that certain things are going to be replaced. I think maybe we'll have other jobs, but those particular jobs will be replaced. And that's hard. You can't ask the company to change themselves to work themselves out of a job, So, it's a human change control problem is the one that we're fighting to deal with.
But is that almost just an everyday thing, though, for a company? There always are changes coming?
There are, but the magnitude of this change, I mean, I've been through, the internet revolution and, the PC revolution and the mobile revolution and moving to SaaS and all these things. And I'll tell you, this is the most profound, the most difficult, the most impactful change that we're going to see in our career. So, I'm sure this is going to affect every single business, but tech is a little bit at the forefront. So we're going to see the pain first, and we're going to have to figure it out.
And just actually building on that point, what's your perspective on the concept of tech debt and having different systems? Because you've seen generation after generation, and I fully agree that this is going to be the next big thing and subsume other histories that we have seen. But how do you think of tech debt in the context of that?
You know what? It's so interesting because in the past, as an engineer, I've always been about get rid of that tech debt. Let's focus on the future and build a system that has a strong foundation. And the weirdest thing has happened because of this AI revolution. We can actually, it's almost a free pass that's given to the companies that did not invest in tech debt. Because for the first time, we can actually employ AI and we can almost reduce the gap for the companies that have been investing heavily in technology and the ones that haven't, which makes me feel good because Canada is behind in investing compared to our US compatriots. So this AI boost actually can help us minimize that gap that we've seen in the past and kind of supercharge us because all of that work to go and eliminate that tech debt is now dropping. It's almost like deflation because today, if I go and do the work to eliminate the tech debt, if I wait a year, my price is now half. And I wait another year, it's half again. So that's what's kind of exciting.
Interesting.
And just going, you mentioned about Canada. What would you like to see this country do? I mean, we've brought in that champions for companies to try and spur on AI and quantum computing. Is there more the government could be doing? You're here. You've stayed in Canada. What would you like to see them doing?
Look, I think that the best thing that government can do from my perspective is keep the taxes low, make sure that there's an incentive to reinvest in the economy so the money goes back into investing in startups, into companies. I don't feel that government should play a huge part in trying to move the chips around. Every single time we set up a battery plant and we kind of go, oh, well, things have moved on, we don't do that anymore. So my opinion is let the entrepreneurs do what the entrepreneurs are good at. And I also think that, if given Geotab has been able to punch above our weight, I mean, we have the largest number of connected vehicles in the world, and we're very much a strong player in the US against all the US companies. I don't feel, certainly from my perspective, that there's ever been a limitation us being here in Canada. And I think we just need to encourage more entrepreneurs, more risk-taking. My biggest worry about Canada in general is what an amazing country, what a high level of education, what an incredible place to have your family. But we need more risk-taking. And I think that's would bring more entrepreneurs. And that's the thinking.
Okay, we have to wrap it up there. I'd love to talk some more. But Neil, thank you very much for joining us today. We appreciate it.
Thank you.
That was Neil Cause, CEO of Geotab. Still ahead, Waymo is seeking to raise $15 billion at a $100 billion U.S. valuation. We'll look into what makes the company so valuable after this. And our phone lines are open. Dan is taking your questions. Call us at 1-855-326-6266 or email firstcall@bellmedia.ca. Time to take a look at some of the notable analyst calls and recommendations moving the market. AutoZone shares slipped 2% on Tuesday as Wolfe Research analyst Spencer Hanus cut his recommendation on the car part seller to peer perform from outperform. Wolfe no longer gives a price target, which was previously $4,487 US. Then Mizuho raised its price target on Tesla to $530 from $475, maintaining an outperform rating. Tesla shares closed at a record yesterday amid rising optimism about the company's self-driving technology and robotics efforts, even as its electric car business faces challenging days ahead. Now, for more on this, get some reaction to this, let's bring back Dan Hinton, portfolio manager at IA Global Asset Management. Dan, any of those standing outs that you like?
I think for both. Let's start with AutoZone. It's a bit more of a slower-moving beast, if you will.
Yeah.
This is your mufflers, your wipers. They have a big private label penetration. It's a big business in the U.S. They compete against what's known as GPC, Genuine Part Co., better known more commonly as Napa, and then O'Reilly Automotive, and then Advanced Auto Parts as well. relatively quiet industry. They don't really grow more units. They can grow their boxes, and they basically have a unique working capital cycle where they basically take 200 days, I think it was 150 or 250 days to pay their suppliers, but they collect money from you within 30 days. So,
Beautiful.
So as they grow, they generate a lot more cash than the revenue would suggest, and they buy back stock with it. So call it slow-moving retail automotive industry with a financial engineering component, which is why the stock has been such a killer. And if you want to look at the stock price, don't look at the revenue per se, look at the share count and how much it's fallen. So that's all great, and that's been true for 15 years.
Yeah.
The stock's off more recently, just primarily because this is the most expensive the stock's been in a long time.
Yeah.
So normally when we're looking at AutoZone, we're saying 12, 15, 18 times earnings. I think it got into the mid-20s for for a little bit there before it corrected. So not a big deal, just price correction based on expectations. And then the second one on Tesla is a pretty straightforward conversation of, I've said it before, Roger, in these conversations we've had, is it's not about fundamentals, it's about faith. This is about a different vision for all of mankind. So you have to put a call option on Elon Musk's vision for mankind, and that's really what it comes down to. Because there's very few engineers in the world that can make robotics happen at scale, and you got to give Elon credit where credit is due, because no one would have said, let's start up OpenAI and fund the seed round and the A round when it was a not-for-profit, then basically give up on it and then start a competitor and be in the race in 2 years, which is what Grok is today. So the engineers, the Mozart of our time, the Aristotle of our time, and his belief that self-driving and mass market robotics enabled by AI will happen, that is the bet you make with Tesla. The reason why the stock's been rallying more recently is they're pulling drivers, insinuating that they've got the autonomous driving technology up to a certain level, and then they're going to start continuing the hype on Optimus, which is the robotics business. Once again, it's a different vision of mankind. It's faith over fundamentals, but once again, you're betting it. If you own Tesla today, that is what you're believing, but there's reasons to say, Elon's done it before, why can't he do it again?
Okay, and next up, we're going to bring this one in. Waymo's Alphabet's autonomous driving unit is in discussion to raise more than $15 billion US at a valuation near $100 billion in a financing round led by its parent company. Now, the prior investment round in October 24 valued the company at above $45 billion. The valuation increase underscores Waymo's emergence as a leader in driverless technology, with the company spending heavily to ramp up its fleet and expand into new cities. Dan, I had to read that. What do you think? Is it accurate?
Ironically, it's tomato to the Tesla conversation because there's the other company competing for this prize is Waymo. So
and Tesla, it's a big prize, isn't it?
It's a big prize because once again, if you have autonomous driving, there's different tiers of autonomous driving. There's your cruise control, and then you don't need someone in the front seat, which is known as level 5.
I'm watching a movie going to work.
Yeah, exactly. So that dynamic, there's two companies that are the furthest along in this conversation. Then there's Tesla on the one end, which we just talked about, and then Waymo on the other. There's slight changes in how they approach it, LiDAR versus machine vision, things like that. Mm-hmm. But in the grand scheme of things, they both have the data assets. They've both been collecting it for a long time. And what Waymo's been doing, which has been driving the valuation higher more recently, has been, not that Google isn't a believer in this, but Google's been trying to be more thoughtful in how it's allocating capital. So Waymo's been forced to drive more commercial operations versus more deep research. And what they've been doing is they've been expanding into ride-hailing services, partially in some cities with Uber, others where they go direct. And they're basically a driverless Uber that's basically taking you around. And when you take the driver out of the conversation in an Uber, the price falls over 50, 60%. So you could go from parts of, I believe it's Austin and Phoenix, where they have the biggest penetration, about 25% of all ride sharing. You can go from one part of the city to the other with $10. Significant cost deflation. And
for now, though.
For now, and it's likely as you optimize the technology, get bigger scale, it gets cheaper, and you start wondering 5-10 years down the road, the theory of victory being from the Waymo and Tesla perspective, do I even need a car? I don't want to pay the insurance.
When I can just buy one or get in one for $10 to go across the country,
exactly,
or go across the town.
Yeah, So the break-even math, if you're living in a congested city like Toronto, walking is quite competitive, or Ubering when you need to go a bit further is quite competitive. But imagine this further out in the suburbs for far more use cases, and that's the theory of victory for both Waymo and Tesla.
But would it be enough? Like, are people willing to give up their car, especially in those suburbs? Because then in theory, either you're going to have to wait for a car because there's not going to be enough cars, or there's going to be so many cars to serve everybody's needs that the traffic will be rammed again on.
You know what's interesting about that? I think this goes into the broader conversation about how much of your car is utilized. We both own cars.
Oh, yeah.
Right now they're empty, right?
They're sitting, not doing
So
anything.
something to the tune of 5 to 8% utilization of the car at any given point in time. Uber's worked as surge capacity effectively, where more drivers are incentivized with surge pricing to come on the road and help de-bottleneck and the transportation system. But if you just have 50% less cars or 60% less cars, suddenly the roads feel a lot more emptier, and the network effects in just in time of, what if I need to go somewhere and will the car be here?
And that also means savings for transportation companies and everything else.
I think this is broadly deflationary for all of transportation, and broadly a good surplus for all consumers and profitable for these companies as well. I just think it takes a bit of time. And at one point to really anchor, I can't remember the number exactly off the top of my head, but it was either Phoenix or Austin or LA. Waymo was basically 15 or 20% of the rideshare market, but they only did it with a few hundred cars.
Really?
So it's a lot fewer cars than you might actually think. And that's one of those.
They don't need rest. They don't need sleep.
Exactly.
None of that.
24/7 autonomous fleets. We're not, I would say the technology isn't quite there yet, but it is fast approaching. And the two companies that will get us there are probably these two. And Uber, if they can get a hold of an AV, autonomous vehicle supplier in one way, shape, or form, whether it's NVIDIA with their machine vision models or not. So there's a few players that might be in the wings, but these two are fully driving ahead.
All right, we've got to wrap it up there. When we come back, Dan will take your questions on First Call. Time now for First Call, but we're going to do a first email, and it is from Craig. TRI was a strong performer until 2025. It's correcting. I'm told it now sits near the lower end of its PE. How do you feel now as an entry point, and what do you feel 2026 holds for TRI? Get out your crystal ball.
So I think it's important to start by saying the valuation. So it peaked around $300 or so, if memory serves. That was an extremely high valuation, but I think it was 50 times earnings at its peak, Roger. So the starting points do matter. So corrected from an extreme is where we are. Is it fully valued today? I think the question for TRI you have to ask yourself is, it's really Westlaw and some other adjacent data assets, and are they really capturing the opportunity that comes with legal as it's moving to an AI-enabled landscape from before? So if you were a lawyer in the past, you would go to LexisNexis, which is owned by RELX, a company we do own, and Thomson Reuters, which owns Westlaw. Now a lawyer can go to Harvey, which is the big legal tech startup in the United States, or Legora in the European sphere, and you could start there. So it becomes your ChatGPT for your legal, and it helps you write and basically improve your case and give you angles and things like that.
Yeah.
Westlaw and RELX with LexisNexis are kind of abstracted one layer down. So do I think Thomson has the best strategy for how they're tackling this, where they're trying to go at Harvey alone versus RELX and LexisNexis, which is trying to partner with Harvey? I think RELX has a better strategy here, so I'd be more inclined to go that way. Although I would say Westlaw has a chance to make it work, I'd just be on the sidelines for Thomson Reuters for now.
Okay.
It's not cheap enough to make it a compelling buy.
All right, let's sneak in one more. It's from an email from David. I've owned Visa now for 10 plus years. I add when it dips. Last edition was at 270 in 2024. Would appreciate your thoughts on Visa. Add more now or wait for a market drop?
I'd say keep adding. I think it's a reasonably compelling valuation today. I'm a buyer today. The reason for that, and I like the 10-year strategy, which has proven out to be an excellent one. This is the payment rail. This is the toll road for the world's money. So there's other competing toll roads, things like that. But Visa and MasterCard are compelling long-term investments because wherever money is transferred, whether it's through stable coins, whether it's through crypto, whether it's through fiat, whether it's through precious metals or some type of gold-backed currency or central bank digital currency, these networks will have some role to play in that. So it is one of the more de-risked financial services companies across the global financials landscape. We're buyers today, and I would encourage our viewers to keep that in mind and buy on pullbacks as well.
So they're always looking ahead and always moving forward on opportunities.
They're the Switzerland, right? They don't take a bet on technology. So when there was crypto going on, they were buying little stakes and funding those companies. When Square and what was known as the micro merchant era, if you remember the little doggos that exist at these stores now, they actually were early investors in Square as well. Their goal is to be cheap enough to clear money and say, when you and I transfer money P2P, you're good for it and I'm good for it. That's their goal. Everything else is someone else's technology and pawn to fight over.
Okay, we're going to wrap it up there, Dan. Always a pleasure to have you here. Thank you, sir.
Thank you for your time.
Dan Rohinton, Portfolio Manager at IA Global Asset Management. Thanks for joining us. Andy Bell's up next with the Open. The markets will open a little more than 30 minutes from now. Have a great day.